So welcome back, happy Thanksgiving. Today we're going to be talking about Verizon because Verizon stock has had kind of a rough year, but the company has actually been increasing earnings and increasing outlook. So we're going to see, is it undervalued? We're going to take a deep look into the financial statements and come up with a valuation of our own. Before I start, if you want to read more about Verizon, I have some details in the description of this video, but I think everybody knows what they do. All right, so share price history. So let's look at this chart. You can see over the last year, it has not been fun to be a Verizon shareholder. It's been about a slow and steady drop of 15%, which is very disheartening if you're a shareholder. That's the kind of stuff that you just hate seeing. Now, have we reached a bottom? Are we ready to come back up? If you want to know what it's going to do in the next week, flip a coin, to be honest. That's my opinion on technical trading, but we're going to look at the financials and see if we think it's overvalued or undervalued. So let's start with the income statement. First up, as always, total revenue. And you can see our revenue, it was growing. It's kind of flat. That's okay. Really here, we're just making sure that revenue is not decreasing. We don't see any big spikes down. There's nothing to concern me here, but we do not use revenue for a valuation metric. It just should always be looked at. All right, next we're going to look at operating margin. Sometimes I use gross margin, sometimes I use operating margin. In general, if it's a manufacturing company or a retail company, somebody that's either making products or buying stuff and reselling it, I use gross margin to judge competitive advantage. If it's somebody that's more service-based, like Verizon, who does a lot of wireless cell service, I'm going to use operating margin. All right, so over 20% operating margin, that is in my good zone. Over 20 to me is good. It's not great, but I like seeing this. This is a plus. So next we're going to look at interest payments divided by our operating income. So I love this metric because it tells me how much a company is relying on debt to make money. Let's take a look at their pattern here. So I don't like that they were hovering around 20%. That worries me. I hate the idea of sending 20% of your income to interest payments. That makes me sick. But recently, look at this. It seems like it made them sick too, and they decided to change it because we're down almost to what is this if I scroll down here? We're down to single digits, 9%. So I love to see that. I think the company's moving in the right direction as far as debt and interest goes. All right, next is going to be our pre-tax income, our first valuation metric. All right, so look at this recent growth. That's awesome. You went from $6 billion a quarter to $8 billion a quarter in pre-tax income. That's a great sign. It seems like they were stagnant for a while and now they're growing, and that is great. So what number are we going to use here? I don't have a good outlook on their income. I don't want to be super aggressive and say they're going to stay at this 8 billion, although that's entirely possible. I think 6 billion is a little conservative. So what I'm going to do is just split the difference and say 7 billion per quarter. So if I do that, 7 billion per quarter times 4, that's $28 billion for the year. That's going to be what I put in the outline section over here for our pre-tax income, 28 billion. All right, and now we need a growth rate. So our growth rate, we look over the last 5 years. So what I do to get growth rate is I say, what are we now? So $8 billion a quarter, that's what we're making. And then what were we making 5 years ago? So if I go back 5 years, it's about in between 6 and 7. So let's say 6.5. So that calculation is going to be 8 divided by 6.5 and raised to the 1/5 because you're trying to get an annualized growth rate. And so we're going to get 4.2%. I'm going to round down. I just love single digits. So 4% is our growth rate. All right, great. Let's go to earnings per share. All right, so we're still seeing that same growth. That's a good sign. What was this? They made a huge jump in earnings one quarter. So in general, if you did not see a spike like this in pre-tax income, but you see it in the earnings per share, you need to check out that tax provision and see if they got a huge tax benefit or something. So if I was looking, tax provision, yeah, they got $15 billion in taxes back. All right, so one thing to be careful of is if you see a big outlier like this, do not include it in your calculation. You're going to get an overvaluation and you're going to think that you found a great deal and then you're going to lose money. So don't include this. I know it was a long time ago, but I just wanted to point that out. I'm going to take the trailing 12 months, so sum this one, this one, this one, and this one. So if I do that, it's going to be summed off screen, but it sums to $5.33. So on my outline section, that's going to be my yearly earnings per share, $5.33. Awesome. Let's go to the balance sheet. First, we're going to look at total assets, and I'm going to write this number down because I'm going to use it later in the balance sheet, and you'll see why. So 350 billion. I just wanted to write that number down. That's what it is right now, 350 billion. Okay, We're going to look at the assets to liabilities ratio of this company. So total assets divided by total liabilities. And we like to see this ratio above 1. I like to see it above 2 because it would mean that you have twice as many assets as liabilities. Above 1 just means you're not upside down. They're flirting with 1 a little bit. I mean, they're right about 1.2. It's not great, but like I said, at least they're over 1. What happened here? All right, let's look at our current ratio. So current ratio is your current assets, which are assets that are going to turn into cash in the next year, divided by liabilities, which are liabilities that are going to require cash in the next year. So this is a good way to see, do you have enough current assets to meet your current liability? Pretty self-explanatory. You don't want to be less than 1 because you may not have enough cash to pay your current debts. They're hovering around 1. I really don't like to see this that low. It is what it is. Let's move on to the book value per share. So if I go to book value per share, what the heck happened here? So we were climbing good and then boom, drop off in book value. So we need to see what happened here. I didn't see an increase in assets if you remember. So I'm going to look at total debt and see if something happened, if they went into a lot more debt. Yep, look at this. Went from $50 billion of debt to $100 billion, doubled their debt load in 1 quarter. I don't know what that was all about. Maybe we'll find out later as we keep on going. All right. Next, we're going to look at tangible book value. So this is the book value per share, but before we divide it by the number of shares, we subtracted out all of the intangible assets. Okay, so this is not good either. This is negative. So they're relying on a lot of intangible assets and goodwill, either one. So let's see which one it is. Is it goodwill or is it intangible assets? So here you can see I got goodwill and intangible assets. Let's look. Is it goodwill? Goodwill is $25 billion. Here, now I'm going to go to the calculator. What percentage of our total assets is goodwill? So 25 divided by 350. 7% of our total assets is goodwill. That's not bad at all. Goodwill is what happens whenever you purchase a company and you pay over the book value, which is what we do every time we buy a stock with a PB over 1. So anytime a company is making acquisitions, they're going to carry some goodwill on their balance sheet. It's not a big deal. I would never get too concerned by it. But I also would not include it in calculations of net worth or liquidation value of the current company. Okay, so let's go to intangible assets, see what this one is. Yeah, wow. Okay, so recently we're at $150 billion of intangible assets. What? That's the highest I've seen it percentage-wise, I think. So 43% of their total assets are other intangible assets. That's a head scratcher for me. I think even if the stock's going to be at a discount, this question needs to be answered before I would buy it, is what are these intangible assets? That's strange. It could be just the data gathering error from the software I use to get all these numbers, but it's worth looking into. All right, let's move to the cash flow statement. Free cash flow. Look, we had a huge dip here. What is that all about? There's a lot of funny things going on here, but I think they might all be related. So before I get a free cash flow number, I want to try to figure out what this dip is. So free cash flow is your cash flow from operations. So how much cash came into the company's checking account from its normal operations. And then you subtract out capital expenditures. So capital expenditures are like reinvestments into the assets of the business. So first I'm going to look at operating cash flow. Okay, nothing there that would cause a big dip in cash flow. So now I'm going to look at capital expenditures. Oh, yep. $50 billion in capital expenditures. And that kind of coincides with that big uptick in intangible assets. So my question would be, how did you spend $50 billion on something intangible? I'd have to look into it. Like I said, it could just be the software I use to get all the data. Let's go back to free cash flow and get a number real fast. So I'm going to ignore this one and I'm going to take an average of the last 2 quarters. So if I take an average of the last 2 quarters, here I get $4.9 billion per quarter. So I'm going to get a yearly number from that. I'm going to say 4.9 times 4 and get 19.6 billion for our free cash flow. Okay, last metric for our cash flow statement is going to be dividends. So let's look at that. All right, this is great. This is a good sign. So increasing dividends tells me the company feels confident in its earning power moving forward, because the company will almost never increase dividends unless it thinks it can sustain it for a long time. So I like seeing increased dividends. And look at this. So 2.5 billion a quarter is what we're at now. So 2.5 times 4. So they're spending $10 billion a year in dividends. And that's look, our free cash flow was 19.6. So they're spending over 50% of their free cash flow returning money to the shareholders. I got nothing bad to say about that. Okay, let's go to valuation. First thing we're going to look at is our pre-tax income. So we take our pre-tax income, what was it? 28 billion. 28 billion times 10 divided by the number of shares. So the number of shares is 4.14, and we get 67, I'm going to round up, $68 per share as our price target. Great. All right, next one is going to be our earnings per share calculation. So we do 5.33, that was our earnings per share, times 8.5 plus 2 times the growth rate, and our growth rate was 4%. All right, $88 a share, looking good so far. And lastly is our discounted cash flow. So we're going to say free cash flow, which came in at 19.6, so 19.6. Perpetual growth rate, I'm going to put 3%. It should always be less than what number you put for your other growth rate. And then discount, I discounted 15%. Okay, so that net present value is going to be $188 billion. So 188 divided by 4.14. And I get a price target for the DCF method of $45 a share. All right, so we have three numbers. The average is 67, which is 30% upside from the current share price. The pre-tax number, that's my favorite. That valuation has been so good for me. The earnings per share one usually is a little bit on the high side. The DCF one is usually pretty accurate too, but I think we put a pretty low free cash flow. So if they get their free cash flow up close to what their pre-tax income is, you're gonna see that valuation creep up. So the stock, in my opinion, is obviously selling at a discount. Does that mean you should run out and buy today? No. I think there are some serious questions that you need to answer and make yourself feel comfortable with the stock before you make a purchase. The questions are primarily surrounding the balance sheet. So they have a very low assets to liabilities ratio. Their tangible book value is negative. They rely heavily on intangible assets. You need to figure out what those are, first of all. If this stock wasn't selling at such a discount, those alone would be enough to make me ignore it. But to see 30% upside, I think it's very tempting. I'm going to be looking into that a little further myself. Positives besides the discount are just the increasing dividend and the decreasing interest ratio. So they're relying less and less on debt. That to me is a great sign. But I really want to answer those questions on the balance sheet before I buy it. So anyway, if you enjoyed the video, if you learned something, please like and subscribe, and I will see you next time.